Hi guys, welcome to my channel. My name is Burcu, call me Blue. My channel is all about finance. I cover different topics in every video. These are all education purposes. I'm not an investment advisor. Please do your own due diligence. Thank you and enjoy the video. Thanks a lot. Today we'll cover options. There are two core types of options, call options and put options. Call options give the holder the right to buy the underlying, whereas put options give the holder the right to sell the underlying. If we expect the underlying, like stock or ETF, price to go up, then we enter a call option. If we expect the underlying price to decrease, then we would buy a put option. Options are different from stocks, majorly because they are contracts with expiration dates. This is very important. You can invest your money in a stock and wait many years, but for option contracts, you have to keep an eye on the expiration because those options will expire at some point, either worthless or in the money, so that you may collect your profit. Options have strike price. If we long the option, we can exercise it at that strike price if it's in the money. If we short the option, then we will have to either sell or buy the stock at the strike if the holder exercises it. So there are also two types of option styles, American options and European options. Most of the options, like options on stocks, ETFs that we trade, are American type. American options can be exercised at any time up to expiration date, whereas European options can be exercised only at expiration. If we buy an option or sell it, we should consider the exercise style. If it is American option, then we should always keep an eye on that, particularly if we short the option. Imagine that we buy a call option on SPY. SPY is an exchange traded fund, ETF, that tracks S&P 500. So SPY options are American options, unlike the SPX options. So this table depicts a possible scenario of profit loss that we can get from 10 at-the-money call option contracts on SPY with strike 444. You can see the profit and loss here. We can also see the profit and loss distribution of the equivalent investment on the SPY itself. So this shows us the leverage that options provide when we compare these two. We can make much more profit by buying the options compared to equivalent stock ETF investment. However, we should also consider the downside risk as well, because options can expose us larger loss depending on the premium and the number of contracts we hold. This chart shows the payoff of this call option on SPY. Because the strike is 444 and the premium is $0.68, the break-even price is 444.68. We should of course take into account the commissions, which is a very real thing, and can be around 65 cents depending on the broker per contract. So break-even then effectively will be 445.33. And also in those break-even calculations, we should also consider the hidden cost, which is the bid-ask spreads. Always keep an eye on the spread before entering an option. Here is a similar calculation on a put option contract on SPY. So you can see the return on investment as the price goes down. You can also see the payoff diagram here right below. And having a long position on a put option is a bet on the decrease of the underlying. So here I also want to show you the options chain on SPY, which has the expiration August 23rd, 2021, which is basically tomorrow. You can see the call options on the left and the put options on the right, and strike price in the middle. You can also see the delta and theta of the option. So delta is the sensitivity of option to the underlying. It's like the probability of the option to expire in the money at expiration. Whereas theta measures the time decay, having negative values. So we'll go into the Greeks later more in depth. So for the volume and open interest, while volume shows the number of contracts traded in a given time period, Open interest like represents the number of contracts that are active, like ready to be traded. So as an analogy, like you can say that like open interest is like for derivatives is like float for stocks. So a useful indicator for the options market is the put-call ratio. So put-call ratio shows the relative volume or open interest of puts to that of calls over a certain period of time. If the ratio is above 1, then this means that there are more volume or open positions for puts than calls, and this is an indicator that the market is bearish. On the other hand, if the ratio is less than 1, then the market can be considered as bullish. So just like the stock and ETF markets, there are market makers for options as well, who set bid and ask prices where we can sell and buy respectively. When the option is very thinly traded, particularly late in the day, the bid-ask spreads can widen incredibly, and this can be a big consideration before entering a trade. While also trading options, it's also important to know the settlement time. For the option, the settlement is T plus 1, whereas it is T plus 2 for stocks or ETFs. Thank you very much for watching. We'll cover next time factors that impact option prices. Hasta la próxima!